New quarter, same story. Yields up, stocks down. Live from New York City this morning. Good morning, good morning. Your S&P near session lows. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Live from New York, coming up, the bond market sending yields to new cycle highs. The nation's capital distracted by a GOP power struggle, and Sam Bankman-Fried's trial begins in Manhattan. We begin with the big issue. The vigilantes are back.
Bond vigilantes that we thought were gone and clearly have come back.
This huge rise in Treasury yields as the vigilantes take over.
Higher for longer in bond yields is really about that deficit size.
So much of this is the fiscal side.
The US fiscal deficit and those high debt levels.
It's going to keep rates probably higher than certainly what we've been seeing in the last 2 decades.
We had the central banks running the show for a decade post the GFC, and it's really flipped.
The budget deficit continues to grow and at some point needs to be dealt with.
Supply is a good portion of it, right, to fund all that debt.
The Treasury came and surprised the market with this new needs for supply.
There is a supply-demand imbalance potentially coming.
There's just too much supply coming against QT.
So much supply out there and likely a whole lot more coming our way.
Really, something has to happen to make more people want to buy more bonds.
I have a hard time believing that you're going to see meaningful downward pressure on the curve.
We could see much higher rates.
We're expecting a little bit of a leg up.
Bond yields at new cycle highs. Joining us to discuss is John Hancock's Matt Miskin, Ashok Bhatia of Neuberger Berman. Matt, first to you. Are the vigilantes back?
This is the 2008 of bonds, and I'm actually looking for more capitulation. I mean, what's trending on Twitter right now is Treasury yields. So we've got Taylor Swift and Travis Kelce as the top media trending event in Treasury bonds. I haven't seen that before. I never thought I'd see it in my lifetime, but it's amazing to see what is at the top of investors' minds. I go back to the basics of bonds. If you bought bonds last year, you're probably looking at 4 to 5% income stream from the aggregate bond index. That's what you locked in for the next 5 to 7 years. Now you're getting almost 5 to 6. We think 5 to 6% is going to be an attractive yield. But right now, again, it's a 4 standard deviation event in the bond market. It's 08 of bonds. That's where the value is, but it is coming with a lot of volatility.
If that's where sentiment is, maybe it's a buy. Ashok, when we spoke earlier in the summer, you were talking about potentially adding duration if yields pushed higher. They've pushed higher. Have you added duration?
Morning. Yes, we have added some duration. It's been pretty selective, though, in some of the shorter maturities, so 7 years and in, with a lot of focus on 2-year to 5-year maturities. I think, the long end is struggling with a lot of issues related to term premium, and that ties into the vigilante conversation, fiscal supply, foreign bonds. So the back end's a lot, I think, harder to call. But at these levels in 2s to 5s, we are adding a little bit of duration.
To your point, Ashok, not all sell-offs are created equally. Can you identify what you think is the big driver of what's happening at the long end on a 10-year, on a 30-year?
Yeah, I think there's 2 or 3 big issues. One is cash yields are still higher than a lot of fixed income investments. So, investors are still being incented to own a bank CD or a money market fund or short duration cash. The curve is still inverted. So that's creating some incentives just to keep, hands down. Second is the pressure from foreign bonds and issues related to hedging costs and less demand from the Chinese and Japanese investors because of where yields sit and hedging costs. And the third issue is the rising term premium. We're leaving from a period of negative term premium from QE, and with fiscal supply coming, that's starting to revert. So I think all 3 of those things are sort of in the mix for why, particularly the back end, is really having a hard time finding some stability.
Let's pick out point 2. This came from Torsten Slog over at Apollo. He said this on China. He said growth in China is slowing for cyclical and structural reasons, and Chinese exports to the US are lower. As a result, China has fewer dollars to recycle into treasuries. In fact, China has been selling $300 billion in treasuries since 21, and the pace of Chinese selling has been getting faster in recent months. Matt Miskin, do you subscribe to that theory as well?
There seems to be some sort of whale that is selling treasury bonds. You remember in the old day, John, when you actually had an economic data point that would drive treasury yields? Now it's just a day that ends in Y is causing yields to rise. I mean, the Sunday scare, like last Monday, 10-year was up 10 bips. This Monday, it's up another 10 bips. And there's no data. There's inflation data isn't the problem. Core PCE is running over the last 3 months about 2.2% annualized. And yields are skyrocketing. We're seeing credit card spending data actually weaken. China, the biggest thing for us as it relates to China data, is just amazing how much the treasury bond market doesn't care about China weakness, about European weakness, about global growth weakness. And again, I do think it's some massive investors that are trying to trigger this or sell it. But that's, again, when those yields rise, that's where the value is. And so China or other governments or some other big investors are selling. Again, on the flip side of that, there's a lot of value to be had in high quality bonds.
Matt, you say it's not higher for longer, it's higher until something breaks. I hear that a lot. What do you mean by that?
Well, that's what just history teaches us. Whether it's 2000, 2007, the backup in yields eventually caused a liquidity event. And we're likely, you can see it in the market, John, as you're watching this, you can see the liquidity being pulled out, whether it's utilities, whether it's precious metals, or even potentially copper now, or broadly, you're starting to see the liquidity come out. And as that liquidity drains, the tide's coming out, and you're going to find out who's swimming with their shorts or not. And so at the end of the day, that's what we're trying to protect against. We are still very much with a conservative and defensive mindset, looking for higher quality assets that are going to have good balance sheets, but you got to protect against that.
We found some banks swimming naked in the spring. And to that point, Ashok, I just wonder whether the Fed's response to that issue, those issues in the spring, have neutralized some of the banking issues now. We know that there are a lot of bonds at the long end trading at something like 50 cents on the dollar for some of these 30-year issues that were issued, supplied, came to market a couple of years back. Those unrealized losses that sit on balance sheets, Ashok, have we neutralized some of those issues given our response to the banking issues of the spring?
Our view is that we would be surprised if we see a resurgence of the banking issues to the extent we saw in March with, a couple of banks having to at least a couple having to go into FDIC receivership. I think pressure, though, on the banking system and with, rising funding costs, asset deterioration, those types of issues in the bond prices, there's probably a little bit more balance sheet and, earnings weakness coming in pockets of the banking system. But we don't think it's going to rise back to what we saw in March.
Matt, do you agree?
We still see weakness there. You look at the stock prices. The markets are facing all their fears: higher dollars, higher interest rates, regional banks seeing weakness on the prices. I think there's a lot of risks that are still morphing into this market, and you're not getting compensated that well in terms of valuations, whether it's equities or high yield or credit. And so again, higher quality looks like the opportunity for us.
To that point, Ashok, just on high yield, spreads have started to inch wider through 400 basis points. Do you see value there yet?
No, we have reduced credit exposures. We've been doing that for about 6 months, and I think what's interesting about this most recent period, the last 6 weeks in the bond market, or one of the things is we have seen weakness in the credit markets. So high yield spreads, 40 basis points or so wider from the tights. We've also seen the curve steepen, and curve steepening again today in this sell-off. So the complexion of the market is the sell-off is changing a bit, and at these levels, we think the tail risk is still in wider credit spreads. I would characterize our positioning as defensive in credit and high quality as well.
Let's talk about the sell-off this morning in the bond market. To Ashok's point, a bit of steepening coming through the curve. The 30-year yield higher by 4 basis points. The 10-year up by about 2. The 2-year pin going almost nowhere at 5.1%. The 10-year earlier on this morning, 474. Right now, about 470. Tons of economic data out there. Matt Miskin's looking for some. Mike McKee, we're going to get some later and through this week, aren't we?
Yeah, we're going to get the JOLTS report today, and then, of course, the jobs report on Friday. If a picture is worth 1,000 words, or $2 trillion, this is what is happening in the markets these days. This is the yield curve from 1 month ago, the blue line, and the white line today. And you can see what's happened with the markets finally seeming to get on board with the idea that the Fed wants to keep rates higher for longer. Do they need to go up any further? Well, the Fed is kind of divided over that at the moment. The hawks say yes. Loretta Mester yesterday and Michelle Bowman yesterday, both saying we may need to raise rates further. But you've got the doves, John Williams, we're at or near the peak level. Tom Barkin saying essentially the same. And then the real bottom line expressed by Michael Barr, the vice chairman of the Fed, who doesn't talk about monetary policy much, but did yesterday and said the most important question at this point is not whether an additional rate increase is needed this year or not, but rather how long we will need to hold rates at a sufficiently restrictive level to achieve our goals. And that's going to depend on that data that you are talking about. We have seen, as your discussion was pointing out, inflation come down. Now what happens to the labor market? Here's JOLTS, and you can see the division. You go over on the right-hand side, and you can see where the jaw is starting to close. And does that continue to close? That's hirings on the bottom and openings on the top. If that continues to close, then the Fed sees progress being made, and they will look at that in terms of how long they need to keep rates higher. But we've got a lot of data this week that they can focus on.
Mike McKee, thank you, sir. Need to look at the data yesterday as well. Mike, thanks again. The ISM manufacturing better than expected. I should say less worse than expected. Matt Miskin, that factory read contracted in September by the least in nearly a year. This from Andrew Hollenhorst of Citi. The upside surprise in ISM manufacturing further confirms the manufacturing PMIs have bottomed, could go above 50 levels. If that move above 50 materializes and is sustained, it would make a near-term recession even more unlikely. Matt, is Andrew Hollenhorst wrong?
You know, the bond market's going to decide whether or not that's right or wrong. And, you know, again, you're fighting the Fed. The economy is fighting the Fed right now. And I almost think about it like a Muhammad Ali, where the summer months was, you know, a rope-a-dope. It seemed like, you know, the Fed was backing off. They were like, oh, we're going to see a recession. We're not going to raise rates as much. And now they're swinging again. And you're hearing as hawkish tone I've heard out of Powell since 2018, where he was fumbling around in a dark room trying to find out monetary policy. That's where we're going back to coming into the close of this year. And I think they're going to have to really push against this reacceleration in economic growth. And again, you're fighting your Fed in a late cycle environment. To us, again, that's why it's hard to embrace risk assets, the rally, small caps, credit, all these things, because you're coming right back to fighting the Fed again.
But Matt, last year the Fed was fighting the market. Let's be clear about that. Now we hear all this romance about navigating stars under cloudy skies. Does that sound like a Federal Reserve that's ready to beat up this market, this economy anytime soon?
Yeah, that was a good one too, I gotta say, John. But, you know, I think really, you know, you're hearing all the FOMC members, you know, what is it, 60% is soft landing, 40% is we've got to raise rates more. There's no hard landing at all in any assumptions. Even look at the PCE on the summary of economic projections for them for year end. I think it's about 3.8%. At this current run rate, they're going to be wrong. Actually, inflation is likely to come in lower than they thought by the year end, and yet they're upping their hawkish rhetoric, which is, again, they're focusing on taking growth down, not inflation. That's a different paradigm. I think that is one that's going to cause risks to continue to manifest themselves in this market.
The question is, are we sufficiently restrictive? And Ashok, there's three potential answers: yes, no, and wait. What's your answer to that?
Yeah, we think we're at the level that it's restrictive. I mean, I think on the point about the manufacturing economy, it is probably bottoming. Inventory levels are low, and, you know, our best guess is there'll be some positive movements there. But the bigger issue is the consumer sector, and I think this is being well discussed, but it's accurate. Delinquencies are picking up in credit cards and auto loans. We're seeing rising pressure that will develop further with the student loan payments coming back. Savings levels have come off. Wage gains are declining. So the next, you know, couple of quarters we think will be defined by slowing consumption, and that's just a bigger part of the economy. And so that leads us to the conclusion these rates are restrictive. You know, on inflation, the bigger fall, it is coming in lower than where the Fed thought. It's probably going to be, a bit of a slower decline the fourth quarter before a bigger decline next year. So I think it's restrictive and think it's an environment where the Fed is probably going to figure out how just to stay at these rates, and the data will probably support that.
Matt, Ashok mentioned some of those consumer weakness issues. We know them pretty well at this point. All the headwinds on the rise in the student loan repayment resumption. We've been talking about that for the last couple of months, anticipating it. Matt, do you think that's well discounted now in the equity market, given the weakness we've started to see come through in the last month for discretionary stocks?
For discretionary, not, discretionary's actually held up pretty well this year. I think overall in terms of the market, small caps, some of the more mid small caps, they're flat to down a little bit this year. So that's priced in some, but Magnificent Seven, the big heavy hitters of the market, are still lifting this market. And that's disconnecting from what is happening in kind of the real economy. We're looking at an 8% mortgage rate, 30-year fixed. And I think at some point, higher mortgage rates is going to hurt housing, and that's going to hurt manufacturing, and that's going to be all tied together through that consumer linchpin. And so, right now, equities have been kind of marching to their own tune. I think eventually they're going to see some weakness as some of the big mega cap names start to hit some valuation impact after rising so much on PE multiple expansion.
You just got to wait like 27 years for those mortgages to roll off and all of that stuff. Matt Miskin, Ashok Vadia, to the two of you, thank you. You're going to stick with us. Your equity market on the S&P 500, negative here by 0.7%. Let's get you some movers going into the open. Here's Abby.
And before we take a look at what is weighing this morning, John, let's take a look at what is working. And we do, of course, have the shares of Point Biopharma absolutely soaring, up about 84% on the news that Eli Lilly is paying $1.4 billion for this cancer drug maker. It is, of course, a small cap stock today, going above the $1 billion mark on the open. As for Tesla, though, it seems as though investors are catching up with that delivery miss. Yesterday, the stock had been weak in the morning, but then closed higher. Right now, down 1.3%. And then finally, Airbnb. It's not every day you hear this, John. The CEO, Brian Chesky, is saying that Airbnb is fundamentally broken and needs to be fixed. He's addressing that, the stock taking it seriously. But on the year into today, Airbnb up 59%.
What a run. Abby, thank you. Coming up, a GOP power struggle.
I think the American people deserve to know the coalition that really governs them. And Kevin McCarthy likes to pretend that he makes coalition with conservatives. But all he really does is break his word with conservatives.
That conversation up next.
I think the American people deserve to know the coalition that really governs them. And Kevin McCarthy likes to pretend that he makes coalition with conservatives. But all he really does is break his word with conservatives. The yellow brick road of working with Democrats has been paved, constructed, engineered, and architected by Kevin McCarthy. If he's able to stay in power, it will be him working for the Democrats, continuing to do their bidding. So this is a revealing exercise, and I think it'll show the country who's really in charge.
Congressman Matt Gaetz officially moving to topple Speaker Kevin McCarthy in a rarely used motion to vacate the chair, citing his support of the bipartisan deal to avoid a government shutdown. Speaker McCarthy replying on X, "Bring it on." A vote reportedly coming as soon as noon Eastern. Gaetz needs support from a simple majority. And if Democrats vote to oust the Speaker, Gaetz would then only need 4 other Republicans to join him. Anne-Marie joins us right now for more. AMH, where's this one going?
Well, John, it was always inevitable, wasn't it? Congressman Matt Gaetz has been threatening that he would go after Speaker McCartney, and now we see it. He has this motion to vacate, and from yesterday, when he put this motion forward, there's 2 legislative days that they would have to vote on it. And so potentially we could see it happen as soon as today. For Speaker McCarthy, it's very challenging given the numbers and the slim majority the Republicans have in the conference. Gaetz only needs 4 other individuals from the Republican side to join him if all of the Democrats vote to get rid of Kevin McCarthy. Now, we just don't know yet how the Democrats are going to vote. Will they potentially not show up? Will they vote present? That'll make it much easier for Speaker McCarthy to clear this slim hurdles, the math. But, Jonathan, right now you have both the Republican caucus and Democratic caucus meeting behind closed doors. And Hakeem Jeffries was on MSNBC, and he said that he wants to listen to all of the members of his family in the Democratic caucus, and then they will vote. They will have a vote pretty much together. He thinks that there would be a vote together, but he also said this is a vote of conscience. So that's going to be very challenging for Speaker Kevin McCarthy, who told CNBC that he's not asking for any sort of deal with the Democrats, even though he has a good relationship with Mr. Jeffries.
What a mess in Washington. AMH, thank you for the update. Matt Miskin, Ashok Badir, a final word with both of them. Matt Miskin, a question I've asked a few times in the last 24 hours. Is Washington losing the privilege of acting recklessly, given developments in the bond market? Do you think they are?
Yes. Actually, I'll keep going, John, but that's the short answer. We're looking like an emerging market country right now. If yields are going to back up like this, as we have this huge fiscal deficit spending, yeah, we're going to have some ramifications for that. And, you know, for 20 years, we've been increasing our deficit. This isn't anything new. Us spending more than we're making in terms of the U.S. government isn't new.
Yep.
But we have finally hit that threshold where this is starting to have meaningful ramifications for interest payments, government spending, and decisions as the government have going forward.
You got me worried, Matt. I thought the line had gone for a second. I thought we'd lost you. Ashok Badir, I want to finish with you, sir. How long before politicians, congressmen, congresswomen are waking up every morning and checking the price of the bond market?
This might be the unfortunate answer, but I still think we're kind of far away from that. Yields, are still, 4.5%, 4.75% in the 10-year. It's still an inverted curve. These rate levels aren't terribly inconsistent with where the policy rate is. So I think the U.S. we still have a lot of privilege built into the bond market, and I think we can all hope that doesn't get squandered over time.
Enough privilege to act just a touch recklessly. Ashok, thank you, sir. As always, Ashok Badir alongside Matt Miskin, to the two of you. Brilliant. Coming up, the morning calls and later, New Edge Wealth's Cameron Dawson joins us around the opening bell on the supply and demand dynamics of treasuries. That conversation is coming up shortly. Your opening bell about 7 minutes away. We started Q4 going absolutely nowhere. We're going somewhere now. We're lower on the S&P by 0.6%. That's the price action. Let's get you some morning calls. Your first call coming from the team over at KeyBank, downgrading Airbnb to sector weight, seeing limited upside due to slowing revenue growth and peaking margins. We're down there by 2.75%. Your second call from Bank of America, upgrading HP to buy from underperform, expecting positive commentary at next week's Analyst Day. That stock is higher by 2.2%, 26.23. And finally, UBS upgrading Warner Music to buy, highlighting the stock's attractive valuation after recent declines. That stock is higher in the pre-market by about 3%. Coming up, a growing chorus on Wall Street, expecting stocks to suffer from higher rates. That conversation up next with New Edge Wealth's Cameron Dawson. Your opening bell, 4 minutes away. Equity futures at session lows. Stocks down, yields higher. We're down by 0.6% on the S&P. Yields are up by 4 basis points. Your opening bell, just around the corner. Recent trends back on track. Kicked off Q4 not doing much, and the bond market doing something. Yields higher, back on track. New quarter, same story. Yields higher, stocks lower. We're down by 0.5% on the S&P, pulling back on the Nasdaq by 0.7%. Some weakness going into the cash open. Your opening bell rings, switch on the board and get to the bond market. New cycle highs earlier in the session. Yields up now by 4 basis points. 471.82. A little bit early this morning, 474. Some dollar strength off the back of that. Euro weakness, 11 weeks of it, and we're on to week 12. Euro dollar 104.70, negative here by 0.07%. And in the commodity market, just short of 90, breaking down over the last week or so. 89.26, we're positive there by 0.5%. At the open, about 20 seconds into the session, we are negative on the S&P by 0.5%. Similar move on the Nasdaq. One stock to watch at the open, HP. Bank of America upgrading shares to buy from underperformance, saying this: we see PC bottoming, cost cuts driving stable margins, and expect a positive tone at Analyst Day. Abby has more. Hey, Abby.
Hey, John. Yes, and so the stock HP is popping on the day right now, up about 2.5% on this double upgrade from underperform to buy. And they are basically seeing these catalysts, that idea that the PC market is bottoming out and that the cost cuts could support stable margins, and there could even be some EPS upside from buybacks. It's interesting they're dealing with the weakness because this stock down about 25% since the July peak. Not so dissimilar from other stocks. It is down 7 weeks in a row, so a little bit more of a losing streak than some of the other technology companies out there. But nonetheless, there's a big macro. But they're also saying that some of this recent underperformance reflects concerns around weaker cash flow and sales of shares by Berkshire Hathaway. Speaking of, Berkshire Hathaway has sold $540 million worth of HP in under a month. Nonetheless, though, John, they still own about 10% of the company. They're no longer the largest shareholder, but again, a 10% stake, at least right now, that's still pretty solid.
Stock is higher by 2%. Abby, thanks for that. Let's turn to pharmaceuticals. Eli Lilly will pay about $1.4 billion to acquire cancer drug maker Point Biopharma. One Lilly executive saying this: "We are excited by the potential and see this as the beginning of our investment in developing medicines for hard-to-treat cancers." Simone Foxman on top of this one. Hey, Simone.
Yeah, Eli Lilly shares down about 1/4 percentage point, but Point Biopharma shares rallying 84% as this news comes through. Eli Lilly will pay $12.50 a share. That's 87% higher than Point's Monday closing price. And this deal is expected to close by the end of this year. Now, Point develops radiation therapies for cancers. In specific, a prostate cancer drug is in a late-stage trial. We should get the results out by the end of this year, and that could lead to regulatory approval. Another drug tests for things like pancreatic or esophageal cancers. A lot of the performance we've seen this year in Eli Lilly shares, they're up about 50% so far this year, has been driven by the enthusiasm around these GLP-1 diabetes and weight loss drugs. Its main drug, Mounjaro, expected to be approved for weight loss as well as diabetes by the end of this year. And so that's why shares have really rallied there over the last couple of months. But cancer still is a very lucrative market. There were $200 billion in oncology therapy sales back in 2022. So potentially something that the company can look out to even after the expiration of the Mounjaro patent. That's 2036, though.
Some way away. Simone, thank you. Thanks for the update. Let's turn to the automakers. Ford has said it's laying off an additional 330 employees due to the ongoing UAW strike. The company writing in an emailed statement the following: "These are not lockouts. These layoffs are a consequence of the strike at Chicago Assembly Plant." Isabel Lee has more. Hey, Isabel.
Hey, John. So that's on top of the 600 the company already laid off from its Michigan assembly plant beginning September 15. In total, around 930 employees are impacted by the strike. And as of Thursday, estimates show that the strike had cost Ford around 8,000 vehicles. You can see the stock softening around 1.5%. And quickly, another auto stock that's moving this morning, Tesla. So the ongoing auto strike, according to a Barclays analyst, will probably benefit Tesla workers' wages. And sticking with Tesla, we have the EV maker reintroducing a Model Y vehicle. That's after reporting third-quarter deliveries that missed analyst estimates. So the starting price is now $43,990, and it has a stated range of around 242 to 260 miles, John. The stock is now trading lower slightly by 1.6%.
To 47. Isabel, thank you. The broader market looks like this about 4 minutes into the session. Lower by 0.5% on the S&P. On the Nasdaq, we're down by about 0.6. Want to turn to the consumer sector. Big focus here going into Q4, looking for potential weakness. McCormick reported revenue that missed forecasts. The CEO saying, quote, "Sales growth in the Americas and EMEA regions was partially offset by an unfavorable China impact." Katie Graffard has this one. Hey, Katie.
Hey, John. Yeah, spice maker McCormick having a tough Tuesday after missing estimates. So third-quarter net sales came in a touch light at $1.6 billion. The estimate had been for about $1.7 billion. And this is interesting. The company's 6% sales growth, it was driven by an 8% increase in prices. That only partially offset a 2% drop in its product volume. For context, analysts were looking for a 0.6% decline, so another disappointment there. And in terms of the why, you laid it out nicely. It's the Asia-Pacific region that was particularly weak. Of course, the company pointing to that slower than expected recovery in China. And in fact, CEO Brendan Foley, he said that the quarterly results were largely in line with expectations if you look across regions, but APAC specifically, sales for the consumer segment in the third quarter declined 16% from last year. You can see that disappointment in the shares, currently off by about 6%, trading at their lowest level since April 2020, John.
Katie, thanks for that. The latest with McCormick. The latest with the bond market looks like this. You need to go all the way back to 2007 to see yields this high. The 10-year high this morning, the cycle high, yields look like this, 474.74. The bond route deepening, strategists are at odds about whether elevated rates could spark further declines in the equity market. Morgan Stanley's Michael Wilson saying this. Stocks have experienced a distinct change in personality, and investors are beginning to question the higher for longer narrative. On the other side, B of A, Savita Subramanian writing this in the last 24 hours. Equities can still work in a higher rate environment. The S&P 500 returned 15%. Every year from 85 to 2005, when real rates were 3.5%. Let's continue the conversation with Cameron Dawson of New Edge Wealth. Cameron, good morning to you. Always great to catch up. Do you think we can live with real rates this high?
It depends on how long they stay high. If real rates stay high for an extended period of time, then this period that we've been in where a lot of corporations and consumers have been able to delay refinancing debt as they termed out debt through the last cycle, that if we're not at high rates for a very long time, maybe they don't pinch. But the higher that rates stay, the more we will start to see it actually filter into the real economy, meaning that refinancings will really start to bite. We'll actually see interest costs pick up, even for larger names. Right now, we're only really seeing it in the small caps because they have more floating rate debt. It's one of the reasons why small caps have underperformed so much this year. So it really is a matter of duration, not just the level of where rates are.
Are you seeing signs that tech is stabilizing in the face of all of this?
Yeah, it's been really interesting. Last week, even as yields were surging higher, you saw tech start to recover some of its underperformance that it had really since the middle of July. And yesterday was mostly startling just because we saw such a huge move higher in yields, and yet tech was up on the day. Now, it's a good question of how much can that continue. Tech valuations are very extended. You know, looking this morning, the last time we were at real rates this high, the Russell 1000 growth was trading at 15 times forward earnings. Today, it is 25 times forward earnings. Now, interest rates aren't the only thing that matters for valuations. It's sentiment, positioning, growth expectations. But at a certain point, you cannot ignore the interest rates when you're thinking about valuing companies.
Do you need rates to fall or just stop going up?
That's a really good question, because it really raises the question of why rates would fall, meaning that if rates are falling because you're going into a weaker economic environment, then it really isn't a good thing for risk assets overall, meaning equities and credit. Usually what we've seen is that in the first cut of the Fed, from the Fed, that you actually see underperformance from risk assets because the Fed is cutting for a good reason. So if we start to see rates fall because we're starting to see weaker economic growth and you're getting that flight to safety bid, it likely means that our earnings estimates for 2024 at $245 a share, up 12%, are too high. So it likely would have to be in context, because if rates are falling for the wrong reason, not great for equities.
So this makes the next question really difficult, whether higher or lower yields would help the banks at the moment. Cameron, at the moment yields are higher, 10-year up by a couple of basis points, 30-year up by 4 basis points. Financials are lower again on the session. What do these banks need to see to start working again?
Oh, goodness. Well, we are in this sort of suspension of disbelief right now with the banks, because they do have the benefit of that BTFP, the Bank Term Funding Program, where even though you have seen this big kick up higher in yields, banks haven't used it more, that program from the Fed. But if we continue to see bank stress, meaning the losses on the balance sheet because of these higher yields, it does raise the question if the Fed is going to have to extend that program. It expires on March 11th of next year, and that could reveal much more balance sheet weakness for these banks. I think there's this hope that yields would fall and they won't have to use that funding program for longer. But I think that's where the risk is as we think of the banks going into the next few months.
Bank earnings in a couple of weeks' time, 2 Fridays away for JP Morgan, Bank of America just around the corner too, the week after that. Cameron, what would you look for from Bank of America executives, JP Morgan executives when we get those earnings reports?
all about charge-offs, watching that really closely, because we've heard from some of the banks like JP Morgan warnings about the consumer, warnings about some corporations having more credit issues. And are they starting to include those charge-offs into their forecasts, expecting that there's going to be more economic weakness? So if we start to see those kick up, that could be a sign that what the banks have been warning about could actually be very real, meaning that this period of economic strength we've been in, it will start to deteriorate. So I think that will be the key message in the next couple of weeks.
Both those names down this morning. We're down by about 0.8% on JP Morgan. Bank of America lower by about 1.6%. Cameron, the bank executives, when I listened to Bank of America specifically, they were basically saying we don't see a recession. You listen to the airlines, domestic-focused airlines, they're saying we're seeing weaker, softer activity. Are you seeing clear trends or conflicting data?
A lot of conflicting data. One of the interesting stats we heard this morning is that 80% of consumers have less cash in their bank accounts than prior to the pandemic. So a lot of these average statistics about cash balances and savings balances are really skewed by upper income households. And we are starting to see more deterioration at the lower end consumer. That's likely what's behind a lot of these auto lending companies going bankrupt, meaning that the people that are more likely to have loans from these companies are starting to default on them. So there are certainly signs that there's fraying at the edges. And the thing that is keeping this from becoming much more broad is the resilience within the labor market, meaning that as unemployment stays low, consumers are still able to spend and survive. If you start to see an uptick in unemployment, that would be the key thing that the consumer could tip over. We do think that the most interesting thing coming out of the ISM survey yesterday was talking about hiring freezes and hearing a lot more anecdotal evidence of companies delaying hiring until next year. If that happens, I think we have to watch really closely for the upcoming non-farm payrolls, because that could be the source of downside surprise.
Tons of labour market data this week. Cameron, thanks for the update from you and the team over at New Edge. Cameron Dawson there. Looking ahead to payrolls on Friday, a little bit later this morning, about 17, 18 minutes away, we get JOLTS data. Job openings, get the ADP report, jobless claims coming on Thursday morning. We're pulling back just a touch this morning. About 13 minutes into the session, we're down by 0.5%. On the Nasdaq, we're down by about 0.7. Yields have been higher through most of this morning. We're pulling back from the highs of the session, though. High of the session on a 10-year, 470, 474, currently just north of 470. Yields up by a couple of basis points off the back of those moves. Bit of dollar strength out there against the yen. 150 is like the line in the sand at the moment. 149.98 is the high of the session. Almost there. Right now about 149.89. Coming up on this program, Sam Bankman-Fried heading to trial.
Clearly, I made a lot of mistakes or things I would give anything to be able to do over again. I didn't ever try to commit fraud on anyone.
That conversation up next.
Clearly, I made a lot of mistakes or things I would give anything to be able to do over again. I didn't ever try to commit fraud on anyone. I was excited about the prospects of FTX a month ago. I saw it as a thriving, growing business. I was shocked by what happened this month. And, reconstructing it, where are there things I wish I had done differently?
Former FTX CEO Sam Bankman-Fried speaking back in November after the implosion of his cryptocurrency empire. The trial kicking off today with jury selection in federal court. He faces a maximum prison term of 20 years for each of the 5 most serious charges, including security fraud, money laundering. He has pleaded not guilty to all of those charges. Let's bring in Bloomberg's Kaylee Lyons from outside federal court. Hey, Kaylee.
Yeah, John, you're absolutely right. Bankman-Fried is facing 7 charges in total, and if convicted and given the maximum sentence, he could very well spend the rest of his life in prison. He could be looking at a sentence of well over 100 years, and really it is his fate that is going to be decided throughout the course of this trial that could last up to 6 weeks. As you said, it begins with jury selection today, and then we will get into the argument phase. Prosecutors, of course, allege that Bankman-Fried orchestrated one of the largest financial frauds in U.S. history. They will say that he improperly commingled funds between FTX, which is the exchange he ran, and Alameda Research, which is the trading firm he also had founded and had insisted was operating separately. They will argue that customer funds were commingled and improperly used to fund risky investments, real estate purchases, and of course also the orchestration of this scheme enabled Sam Bankman-Fried to do things like make tens of millions of dollars in political donations. The prosecution also will be assisted by the accounts of multiple key witnesses, some of Bankman-Fried's closest associates at the time all of this went down. Gary Wang, who co-founded FTX with him, Nishad Singh, who used to be FTX's head of engineering, and Caroline Ellison, who was the CEO of Alameda Research, the aforementioned trading firm, and also his ex-girlfriend. All of them have already pleaded guilty to federal charges and are cooperating with prosecutors, so they will be able to lean on their testimony. On the defense side, though, Sam Bankman-Fried, already leading up to this trial, has said repeatedly it was never his intention to commit fraud, and intention is what is going to have to be proven over the course of this trial. And as you said, John, he has pleaded not guilty to all of these charges.
Katie, thank you. Thank you for the update. Looking forward to your coverage through today. From one legal battle to another, Microsoft CEO Satya Nadella taking a stand in Google's antitrust trial, leaving no doubt about his perception of the search engine's dominance, saying, quote, "You get up in the morning, you brush your teeth, and you search on Google." Nadella also delivering a warning, saying Google is likely to extend its dominance of the search market into a new generation of AI-powered tools. Mandeep Singh of Bloomberg Intelligence joins us now for more. Mandeep, I think we've got to sit on this just for a moment. Can you imagine 20 years ago, Microsoft testifying against someone else about having a monopoly? Just how big is this?
This is huge, given, the CEO of Microsoft is coming and, testifying at this trial. And look, this is a recognition that Microsoft, despite their early partnership with OpenAI and integration of ChatGPT, finds the distribution and data advantage of Google hard to beat. And that's where, the YouTube, the Maps, the Apple distribution that Google has, it gives them a huge leg. And I think that's what Satya is referring to, that because they have that distribution on Apple, they have that feedback mechanism to improve their AI, which Microsoft doesn't have.
What did it say about Bing that the CEO of Microsoft is saying that you get up in the morning, you brush your teeth, and you search on Google?
I mean, look, brand is a big advantage, and habits are hard to change. And especially with internet, once you have a platform which everyone is used to, unless obviously ChatGPT solved for all the use cases that Google had. And that's the problem I think that ChatGPT is having, is they don't have the real-time information that Google has. So it solves for a subset of use cases. It's great for summaries, but those are just a subset of the queries that people do on Google, and Google still has the brand.
Mandeep, how much of a game changer would it be if Apple went in its own way, its own direction?
I think that would be huge. If there's one risk for Google's kind of dominance in search, or what they could do over the next 5-10 years, it's Apple developing their own search. Because look, they have the distribution. In the business of search, distribution matters. That's what Meta is doing. In fact, they launch character-specific chatbots, and what they're doing is the large language model could allow them to do search. That's what Amazon did, integrated search in their ecosystem. So if Apple started to do the same, that would hurt Google.
They have the distribution. Mandeep, how difficult is it to build the business, the product, the service?
Well, so there are different elements to search. I alluded to the crawling aspect. Yes, you need the Gen AI aspect, but at the end of the day, you need to strike those deals with publishers. I mean, a lot of the publishers optimize for search engine, and that's how, all these deals are done. So there are a lot of kind of nuances when it comes to building a search advertising business. But Apple definitely has the balance sheet to do that.
Mandeep, thank you, sir. Mandeep Singh there of Bloomberg Intelligence on this tension between Microsoft, Google, and where on earth Apple fits in the future. 22 minutes in, we're off the lows, pulling back just a touch by 0.2% on the S&P, on the Nasdaq down by, let's call it 0.3. With a sector price action, here's Abby.
Interesting sector composition once again, John, because despite the fact that we have that very small decline, most sectors for the S&P 500 are lower, led by consumer discretionary down about 1%, utilities down about 0.7%. 1%. Healthcare, financials, and of course, something that many of these sectors have in common, yields. We'll be getting to that in a moment. To the top, though, industrials, staples, and technology down ever so slightly, sort of flipping around. As for the last several days, John, it's really interesting because everybody thinks about technology with yields rising, and that's where the real pain is. Well, take a look at the utilities. Over the last 5 days, actually since September 15th, down about 14%. This as yields have simply shot higher. The 10-year yield over the last 5 days up as much as 25 bips. Those dividends are less attractive.
Abby, thanks for that. Coming up on the program, your trading diary, a look ahead to the calendar full of economic data for the week ahead. "25 minutes into the session, pulling back just a touch. We're down here on the S&P 500 by 0.2%, getting a little better as things progress and the session grows older. That's the price action. Here's the trading diary. Coming up, what you need to be watching for: jobs data, job openings at the top of the hour, ADP private payrolls and US PMI data Wednesday. Thursday, another round of jobless claims and more Fed speak. Mester Barkin daily bar. Friday, the September payrolls report. The estimate right now on my screen, about 170,000, down from 187. From New York, that does it for me. Thank you very much for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.